Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets. I'll start with ice raw sugar in New York. Okay, headache time. Third week in a row, and I again must apologize for the multitude of lines and labels that I've had to draw on this daily chart. However, technically there's still a lot going on here, and these labels and lines are all valid in my deciphering, or trying to decipher what is happening here. However, I have shortened some of the excessive head and shoulder necklines rather than just wait for them to push themselves out of the picture. The declines earlier this year below the long moving average, currently 1922, are as a result of three head and shoulders patterns created between August 2021 and January 2022. I have already previously exhaustively highlighted all three of these patterns, so I will not spend too much time on them other than to say that they are complex versions of normal workaday patterns. However, there are some interesting points to discuss. The neckline of the October 2021 to January 2022 head and shoulders top, plus the middle tine, after a fashion I suppose, currently at 1897, managed to stop the decline in this market back at the end of February. The subsequent recovery back up was prompted by an immediate countering weekly key reversal up over the turn of February into March. This recovery rose up to the neckline of the older August to November 2021 complex triple top, currently 2021, breaching it, breaking it even, before the rally failed in mid-April, and we've seen prices drop thereafter, gapping lower even until 2 weeks ago. Now, please keep in mind that neckline of the August to November 2021 complex triple top as it pops up again later on. Anyway, the mess of congestion support around the middle tine, mainly as a combination of February 2021 high, 1894, the medium moving average, currently 1893, the long moving average, currently 1922, and the short medium moving average, currently 1936, eroded the bearishness over the start to middle of May, such that though prices pushed below all of them, the market did not have the impetus or energy to aggressively push lower, below the congestion from February this year, but approximately between 1840 down to 18 even, within which sits, notably, the 50% absolute Fibonacci line for the 21st century at 1809. Thus, 3 Fridays ago, the first bullish shots were fired, with a daily key reversal up, which was halted in its rise by the same congestion of moving averages topside. This rise actually did a lot to fill in the change gap earlier in the month, but is still an open gap. Then 2 Thursdays ago, the market made an immediate countering bullish engulfing pattern. That was the start of a strong move higher, which has only halted last week. It also created some may say artificially, an island bottom over the first 2 weeks of May. Last week, the target for such an island bottom was reached on the upside, such that I have not bothered to place it on the daily chart. Thus, prices have risen up to an area of resistance that currently stretches from 2010 to 2100. This is not a new area. No. You can see a box to the upper left of the daily chart that I wrote. Well, I can't seem to remember when I wrote it, but it details a specific band from January to February 2017. Just on this daily chart, this area has capped the market back in October and November 2021, then again recently in April this year. In no particular order, we have resistances at 2012, 2034, I suppose in ascending order, 2012, 2034, 2027, 2047 I should say, 2070, 2076 and 21 even. We also have that complex neckline from August to November 2021, and that's currently at 2021. As well as a newly drawn middle tine, currently 2011, of the March to May bullish Andrews pitchfork. Admittedly an untested pitchfork, but it's still there. All these are rubbing compounds, if you like, to erode the bullish incentive, which has so brilliantly shown over the past 2 weeks, but in an area fairly empty of significant resistances or supports. Hence now we will start to see pressure being brought from above as prices have reached a level in which they may be confidently applied. Ice Europe white sugar in London. Before I go into the very interesting thing that happened last week, I'd first like to cover some of the groundwork. You see, the market made a big meal from the break upwards out of the September 2021 to February 2022 lopsided diamond pattern. The move up took its own time, but in mid-April, the market reached up to target X in the 572.20 area. This was the target for the mid-February to mid-April bullish halfway hesitation. I will remove target X after this commentary. Since then, we've had the changeover gap lower, and prices have pulled back to the vicinity of the congestion from early 2017 in the 517.80 area. Now, this area is actually a complex support zone, as it also includes the neckline from the August to December 2021 complex head and shoulders top, currently at 521.60, as well as the important rising medium moving average, currently 519.90, and the rising long moving average, currently 510.70, and that's just below. This is why for 3 weeks prices have held over and around the 517.80 area, more or less, and under actually the old gap from March 2017 between 531.70 and 532.70. 2 weeks ago I posed the question, what does this period of intraday indecision, what does it signify? Does it signify a bottom, with prices moving back up to the May 2017 high resistance at 548.70? Or does it signify a halfway hesitation with prices tripping down below all the moving averages, as well as the congestion at 488.10 to 490.10? The answer came during the same week when the market made a weekly key reversal up 2 weeks ago, including yet another gap on the upside. Since then, prices have stabilized over the March 2017 high at 548.70 and corralled on the top side by the middle time, currently 546.40 of the newly drawn February to May bullish Andrews pitchfork. The middle time will shortly give way as the next resistance to the February 20 will shortly give way. The next resistance to the February 2017 high at 565 even, and thereafter to the filling in of the changeover gap between 554 even and 572.5. It'll be interesting to see what the market will make of this ability to move higher here compared to, say, the New York contract, which looks more restrictive on the upside. Sugar white premium, the spread. I said 2 weeks ago that this spread market speaks volumes as to the state of the current New York market and London markets, both individually and collectively. I was of course referring to the 3 weeks between 25th of April and the 13th of May, where we had one indecisive spinning top and 2 consecutive indecisive doji crosses, all in a row. All this came as the market was trying to make sense of a false break higher over March and April from an ascending wedge pattern formed between July 2021 and the middle stroke late part of May. It is, or was, a reasonably good looking pattern. I would not normally expect problems from such a pattern. However, problems are what is being given us, as the lower trend line is the mid-August to 2021 to April broken uptrend, currently at 124 3/4, and the upper trend line, currently 122 3/4, bisected the uptrend 2 weeks ago. As we ran out of space basically in this ascending wedge pattern. And there are 2 further patterns, one of which I'd previously drawn your attention to, which still need to be discussed. The first is the quiet and subtle bullish bow tie formation formed over Christmas last year, made up from the short moving average, currently at 115 1/4, short medium moving average, currently 114.5, the long moving average, currently 82.5. What had been interesting back at the time of its formation was how all the moving averages went in and out of the bow tie in the right order. A rare feat in some markets. Theoretically, the market should move in the direction of the outgoing moving average, is in this case higher, which we have already seen happen. However, the key move should happen between 15 and 20 trading sessions after the crossover. In this case, it would be between the weeks of the 4th of April and the 9th of May this year, or in other words, 2 weeks ago. Now, this may go some way to explain why, after the sharp curtailing of 3 weeks of indecisive patterns, we had 2 weeks of bullish patterns. gently moving the market higher. The second key discussion point I had already spoken about last week, but it is well worth a revisit. You see, 2 weeks ago, the market had a weekly key reversal up. Thus, the market could very well be forming the next phase of its actions, or to put it, as I put it last week, and I quote, wrenching victory from the jaws of defeat by just one action. We shall see. Finally, there is one more pattern I would like to discuss ever so briefly. I'd previously spoken about it this way, and I quote, there is a pattern which, whilst not directly touched, may be indicative of the bullish angle of attack. It is the 2019 to 2021 bullish Andrews pitchfork. The market is currently in between the middle time, which is overhead, currently at 135.5, and the lower time below, which is currently at 61.50. I further added, and I quote, the upper trend line of the ascending triangle runs approximately parallel to the middle time, and that is also something to watch. End of quote. This bullish Andrews pitchfork is still operational, provides with its middle time the next major obstacle should the market wish to extend the recent bullishness even higher. I'll finish with the words of last week, and I quote, maybe, just maybe, we are seeing the beginnings of a new and further, of a new or further move higher here. End of quote. Thank you for listening. This weekly broadcast gives you essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited.